We are going to go ahead and get started. So, hello, my name is Michelle. I'm the event associate at Grid 110. If you don't know what Grid 110 is, Grid 110 provides entrepreneurs with access to community, mentors, and critical resources through no cost, no equity programs. I have the pleasure of hosting this amazing event today with our amazing speakers. I'm super excited to introduce our speakers today. Liana, please take it away.
Awesome. Hello, everybody. I'm Ileana Gonzalez. I'm currently the head of growth at a seed startup. So jump from Techstars Anywhere, which is an accelerator. Ryan Cooter is the managing director of that one. If anybody has met him, I know Carmen has maybe. So I was their venture associate. I was the one sourcing, doing all the due diligence, networking, building community. And before that, I was over at Capital Factory. If you're in Texas, you know what that is. It is the center of gravity for entrepreneurs in Texas. And so that is my background. I decided to jump onto the startup side, right? Because that just essentially makes you a better investor for the future. So super nice to have you. Awesome. I'm going to jump over to Carmen. That's you.
All right. Hi, everyone. Carmen Palafox. I am the founder and managing partner of 2045 Ventures. We're a pre-seed fund investing in companies that are led by immigrant, female, or underrepresented founders. We're generalists, but we specialize in fintech, health tech, climate tech. I'm also a venture partner at How Women Invest, where we back companies that are founded by female founders, mostly at the seed stage. And in addition to that, I teach at USC Venture Capital. So fight on for any Trojans in the house.
Hello, everyone. My name is Marisa Edmondson. I currently work at the Long Beach Accelerator. We're based in Long Beach. I'm the Associate Program and Operations Manager. We're virtual first, industry agnostic accelerator. We are a public-private partnership. So we work with Sunstone Management, the City of Long Beach, and Cal State Long Beach. We are industry agnostic, and previously, I was at USC, Marshall School of Business, so Carmen and I are good friends. But yeah, thank you so much for having me here today, Elle.
And I think I'm the last one. So my name is Will Stringer, founder, general partner at Chisos Capital. I've had a number of different roles. I've worked on the investment team at a family office. I am currently a founder building a software business that is related to Chisos Capital. And then I deploy capital via Chisos Capital in a fairly unique way that we'll get into later, kind of a debt equity hybrid strategy. So I'm here in Santa Monica, so also SoCal for the group here, but I did go to school in Austin, so I also have the Texas connection.
Amazing. Thank you guys so much for your time. Super excited to ask you a bunch of questions. So the way this is going to go down, I'm going to ask some of the questions that were asked from our community. And once the questions have been asked, we're going to go into breakout rooms where you can personally reach out and talk to the investors on a one-on-one basis. We're kind of more like a group chat. So we'll get into the nitty-gritty of that later. But let's start with the questions. Will, I know that Chisos Capital is so unique. I have the pleasure to be part of your portfolio, and you are awesome at all the things that you do. So tell us more, what is Chisos? How does this hybrid awesome thing that's going to take over the world sooner or later work, and how can founders be part of that?
Sure. I'll give you the kind of origin story, which helps explain kind of why we do what we do. So I was in an operator role. Long story short, company imploded. I was looking for what I was going to do next. I come from an entrepreneurial family, so I decided I wanted to start a business. And as I went out to get early capital for that business, I was talking with people in my Texas network, and these people were more conservative investors, real estate investors, oil and gas investors, no angels or VCs. So when I went to them and asked them to invest in my napkin sketch idea, they asked, what's the profit? What's the cash flow? Like, what's the return? Valid questions, but not questions that you usually face from a VC or an angel. You know, they're looking for how big can this be? How fast can it grow? And so instead of kind of coming back to those investors and saying, all right, here's your answers, here's a better business plan, I flipped the structure of the investment and said, why don't you invest in me essentially as a person and my business? So I get capital, you get equity in my business, but you also get this thing called an income share agreement that is tied to my income, my personal income, whether the business works or it doesn't. Very easy sell to those types of investors. And I actually raised my first bit of capital on that structure. And that structure is what has now become Chisos Capital. So we invest in people in the truest sense, underwriting both the business and the individual, and investing with both equity in the form of a safe, simple agreement for future equity, and an income share agreement, which quasi debt instrument, although extremely flexible. Basically, you only make payments when you earn income. So that's the very high level, and that's what we do at Chisos Capital. I'm sure there'll be more questions as we go on.
Thank you so much for that, Will. I appreciate it. Marisa, this question is for you. How does an accelerator program work? And specifically for Long Beach Accelerator, how does this benefit early stage founders?
Yeah, thanks for that question. So accelerators, and specifically the Long Beach Accelerator, we help founders with the resources and runway that they need to grow. So for example, as a nonprofit, our partnership with Sunstone Management, they're the ones that provide the investment into our portfolio companies. And so then they come into our program for 4 months. We provide strategic partnerships and mentorship to the founders, and as well as our cohort alum as they graduate from the program after those 4 months. And so we introduce our founders to experts in all types of funding aspects, as well as banking relationships, as well as industry specific experts based on what business they're in, what industry, their business is in. And so our 4 months of programming is actually broken down by month. And so each topic broadly is product testing and market fit, sales and marketing, business operations, and then acceleration and funding. And so we end our programming with an in-person demo day as well as a virtual demo day. And then the main benefits that I would say that founders can get out of our programming is those strategic partnerships and introductions, and then the assistance to help guide them to get follow-on funding. So whether that is from Sunstone or, investors that they might meet at our demo day, we just want to make sure that the right people are in the room that focus on what our founders are also focusing on to continue on their founder journey. And so whether that's finding more of the right customer, creating and maintaining those strategic relationships that add to additional funding or an exit, we just want to make sure that we are also part of reaching those goals that the founders have when they come into our accelerator program.
Awesome, thank you for that. And Ileana, I know that you have experience with Techstars, which is one of the head honchos of accelerators around the world. Tell me more about, the benefits of becoming part of Techstars, but also I want to say what have you seen that really truly benefited founders when they join a program like Techstars?
Yeah, so very similar, right, to Long Beach Accelerator. It is about putting the right people in the right room. I think something that really benefits founders is a little bit of that hand-holding, right, and walking me through everything that I really need to, analyze within myself of what I'm missing as a founder to build the right team as well and get to know their team, right? We do a lot of strength finders, right? And so you see what each of your team's strengths are and to capitalize on it, right? And so yeah, from business model to product market fit to marketing to really, I did all of the investor relations for our cohort. And that was something that was just a lot of fun, right? Of me teaching them how to negotiate, right? And if they say no, how to get that feedback from the investor. And so that's, I think, making them go through mock-up interviews as well, putting investor day and, getting them in front of the investors to finally see if they will invest, right? on that day or later on. So yeah, just very hand holding. It's for you to truly immerse yourself and know what it is that VCs are looking for and what you need to be successful as a business.
Amazing. That's awesome. So Carmen, I know that you're in the VC world. I have a question for you. At the beginning stage of their fundraising journey, what should a founder do to assess their funding needs and determine the direction in which they plan to take regarding the funding? So I think I want to say more or less to kind of shorten this is like, you know, I know that you invest in pre-seed. Let's start there. What is pre-seed? What does that look like? I know that means a lot of different things to a lot of different venture capitalists. But for, I guess, specifically for 2045 Ventures, you know, at the beginning of the fundraising journey, like when should they come to you and how should they, I guess, what should they be thinking about before they come to you? I think you're muted, sorry.
Okay, great question. And it's a difficult question to answer in general because there's different types of businesses that fall into different types of categories. So I start by delineating consumer versus enterprise. They're very different. And then when you think about the business models, those are also very different. So there are some business models where it's a marketplace where you're taking a take rate, and there's other business models where it's straight SaaS. So I started my career at Mila Capital. I was on the founding team there, and we ran an accelerator program. And so I would have founders start with identifying their top 10 list of ideal investors. And that's a really good exercise because it requires that the founder really identify investors that have expertise in their particular market or business model. And so that's kind of the starting point for me. It goes beyond that, but that's where I start. In terms of what I'm looking at for pre-seed companies, I am looking for what I call a right to win. And that for me is, startups operate in a very competitive space. As soon as you start to make profit, there will be competition. So I'm looking for how is this business going to win? Where's the white space? And what are the strengths of the founder in the space? So one of my portfolio companies, for example, is called Chantico Technologies. The founders have incredible domain expertise. Gina Sanchez is the founder. She's a former CIO to institutional investors and financial advisors. And so she brings a lot of what we sometimes refer to as founder market fit.
Elle, you're muted.
The mute game. Thank you for that. But for the most part, right, I want to say like pre-seed essentially is like normally before you have like revenue, or sometimes before you even have a product, but you have some sort of traction. So, and right before they fundraise,
that's a good point, Ellie, because you asked me, kind of what I look for, and because I wasn't at an accelerator, I'm willing to take a kind of earlier risk in terms of pre-product, pre-revenue, if I know that there's a right to win. Typically VCs will, take that risk again if there's market fit, founder market fit. And we want to know that you are about 6 months out from either having a product or having revenue. So if it goes beyond 6 months, it's a little harder to make an investment and have the money just sitting there.
Awesome. And I also want to ask this question to Liana. Like, I know that you help VCs kind of cut these checks as well, and you have a lot of experience with that. What do you think you know, I know that different VCs have like different metrics of like what they're looking for in terms of that, but you know, what's some advice for some people who kind of want to like assess their funding needs, right? Like what should they be considering as well? Like before like someone wants to approach like Carmen or you or Will or an accelerator in general, what should they be prepared with? You know, like even if there's obviously different stages, but assuming that let's say everyone here is a little bit early in their funding journey, what are they actually looking for? You know, like what are some things you're looking for example, when you're like giving a connection or a warm intro?
Right. I mean, like Carmen said it, right? It's mostly about what is that founder market product fit. So if you don't have a product, if you don't have revenue, if you don't have traction, who are they investing in, right? And it's just like Will's story. He tied it to his income and he said like, no, I'm here to win it, right? And so they're looking for you, your perseverance, your determination, your experience, your how you're going to tackle it, why you're the right person, why you are emotionally intelligent enough to lead a team for success. And obviously, I mean, that reflects on how organized you are. If you put a pitch deck together, if you went out of your way to talk to mentors to see if you can get better at your pitch deck and telling that story for yourself, right? And a lot of times, most of the time, another thing of we want to see what is the heart behind the mission. And so there is a higher conviction from VCs to invest in something that impacted your life or you're passionate about, or you're not just there to make them money, but they know that you will make them money because your heart is right behind it, right? So that is definitely something that they look for. Obviously having your pitch deck ready, being able to listen to feedback and take it back and say, hey, I listened to you, and you can always come back, circle back. Those investor updates every week, every month, however it is that you do them. So it's that consistency that shows you as a character. And
That's
Carmen,
awesome.
add on to what I just said.
That's awesome, guys. Thank you so much for answering these questions. I think this is just like kind of like an open question, similar to the previous one that I asked, but like, you know, at the beginning of fundraising, you know, there's so many options, so many different routes. You know, what questions should founders be asking themselves before they even consider funding? You know, like where are they in their business? Like, what do you want to know? Like, before they even approach you, like what is that due diligence that they should have done before even thinking about funding?
Can jump in here because we look at a number of different types of companies. So we look at companies going the VC route, high growth technology companies. We look at, you know, maybe a CPG company, food and beverage, which is a little bit harder to, you know, get off the ground or raise VC for. We look at, I don't like to call them lifestyle businesses, but some lifestyle, some maybe kind of niche software businesses that are going to get to, you know, $1 to $5 million of ARR eventually, not a VC outcome. Basically, though, what we want to see is that you've done your homework to understand why you're raising. So you've actually done the hard work to build some kind of model on what your business will look like. What are your assumptions on how many customers you will have? What are your assumptions on how much you can sell your product for? How deeply have you gone down the rabbit hole to validate those assumptions? Do you have some kind of traction or orders, letter of intent from a customer? People that are customers have given you money. This is kind of the basic groundwork that has to be done for us to feel comfortable that you're serious about it. Now, we've definitely invested, because we invest a bit different. We've invested in people with, you know, simply an idea, but even if they just have the idea, we make sure that their idea comes from a place of knowledge. They've been in the industry, they've worked in healthcare, they've worked in marketing, and they're building a company to solve a problem that they faced in their career. So they face that problem tangibly, and now they're going to build a solution for it. These are like kind of the just basic things that I definitely see a lot of entrepreneurs come through that haven't done that basic work. You know, they've followed the pitch deck format. They've kind of done all the right things from a surface level point of view, but they haven't really gone a little bit deeper and kind of realized that this is a business that needs to make money at some point. And so you just need to understand the pathway from where you are today as a napkin sketch, essentially, to actually making money on a sustainable basis. Now, maybe you're going to go VC, you're going to raise, $1 billion and not make money for a long, long time. That is a pathway that works. But just know that versus, if you're going to try and be profitable in year one, just understand that.
And I'll just add, for every company that moves to the diligence stage for 2045, we do 1 or 2 calls on financials and projections. So, even at the early stage pre-product, I am looking for what your revenue stream look like, how many revenue streams you looks like, what your hiring plan looks like. That comes in the form of headcount, and really drilling down to better understand where your break-even point is. So that goes beyond kind of the pitch deck to what it takes to get an investment from 2045.
And you may be totally wrong or you probably will be totally wrong on your first go at it, but you got to have something there that shows you've kind of done the thought work to have a hypothesis on what it might look like. And yeah, you probably will be wrong, but at least you've done that initial work.
Amazing. This is really valuable information, guys. Like, as a founder myself, I think that's something that they highlighted really well is the idea of validation, like making sure that you understand what you're getting into as a founder, and then helping tell that story through the numbers that they're looking for, right? Because I think VCs and angels and essentially fund companies that fund you are just looking at your homework, right? Because you're educating them on what you're building. So I think that's just really wonderful and valuable information.
And I want to add to, right, what Will just finished with, which is you might be wrong, but you kind of need it. Like, this is, my God, I'm seeing so many founders just pretty much like, okay, like it's a checklist, right, that VCs are asking me for, but like, be a little bit more mindful as to why they're asking for it. It's because in the long run, you're gonna have to have it, right? It's not just a checklist for you to get the funding. It's for you to learn it and to really then be able to apply it. Whether it is that you're wrong the first time, you will be wrong a lot of times with those financials, but learn how to do it with them, right? Not just like, I'm just seeing so many founders like, oh, the VC checklist to see if I get the money, right? Like, no, like really think why they're asking for it.
One thing that I just wanted to add to is that, it's a good idea, like, as like a concrete thing that you can do is like a 3-year projection, right? Like it's monthly, maybe, right? Making those assumptions, just like, everybody has said here, making those assumptions is hard and you might be wrong, but you really want to find that balance between what is going to attract the VC funds that you want, but also being realistic and the things that your business can do, right? You don't want it to be so huge, right? That in them getting to know you, maybe they're not seeing like, this is something that this person can actually do. Like, make sure that you make it realistic. And then that'll also help you to make sure that you can actually meet these metrics that these investors might be asking you to reach in order to get that funding.
Amazing. Thank you so much, guys, for these valuable insights. I'm still learning, so this is also great stuff to hear for myself as well. I would love to move on to the next question, right? And this, I think, is a little bit geared to Will. As you know, like, I know you reached out as a founder and as an investor, like, when should one reach out to an angel investor? This is a community question, but also I'm going to tie it with another question that's kind of like similar. When should one reach out, but where do you actually find these people? I know that a lot of the kind of things is like networking events, which is great. Like, networking is, I think, just core, essential. Like, this is, even if you're an introvert, it's just something you got to do. Like, if you're in the business to make money and you're trying to find customers or find investors, whatever, like, networking is just key. But like, can you be a little bit more strategic about how you network? Because I think you can't just attend everything and everywhere. I think our time is so finite. So what does it look like? Like, I guess I would love to hear from your personal experience. Like, what did you do, Will, when you started looking for these investors?
Yeah, mine a little bit different. So, I worked at a family office. So when I worked on that investment team, I got to meet a lot of investors. So a little bit of an advantage there. But I will say when I moved into the startup and early stage space, I didn't really know anyone. Most of my network was more private equity. And so for me, it was a few different things. It was getting out and going to events. It was trying to kind of join in on some communities, whether that's a Slack community or, an actual in-person community. LA is an example of, there's like 5 startup events per week at minimum around LA. And so just getting out and going and seeing some of the same faces and really kind of starting to make friendships. That's a big key. That's a big part of it, because if have more than just, an acquaintance or, a request that you send to a person, you actually know that person, you've talked to them before, like there's a real relationship there, you're much more likely to get some kind of, more insightful advice or more genuine help, whether that's an introduction or, some kind of, other insight. But like, be human, like build these relationships, and it takes time. Twitter is a great tool. I've made a ton of good Twitter friends, connections, say over the pandemic, that I then started seeing out in real life here in LA over the past 1 or 2 years. And it translated, right? Like I only knew them over Twitter and DMs and stuff. But then when we meet in real life, like there is already that relationship there. It just gets stronger. So there's really not a great shortcut. And like Michelle said, it's kind of creating those relationships over time that will pay dividends later on.
And I would add, angels, like investors, come in different kind of shapes and sizes. There's angel investors that invest on their own. There's angel investors that invest in groups. Angel investors that invest in groups look a lot like VC funds because they have a process that often takes, a few months or at least a month. And so be cognizant of that. The portfolio companies I've invested in, their angels are very strategic to their business, and they provide a signal to other investors. So have an investment in Momodo, which is a cybersecurity company. Her angels are chief security officers and CTOs at different companies. And that really provides a signal to other investors that, one, they'll be able to get in front of potential customers, but 2, that their product also is relevant in the industry. So my advice would be to think about everyone on your cap table. If you don't understand what a cap table is, make sure you do. There's a lot of resources online because everyone that comes on your cap table, anyone who's an investor, whether they're an angel or VC, should be able to provide you more than capital. Even if they don't, they should be able to help you accelerate your business.
Awesome. Yeah, I have met my angel investors in really like communities for like Latinx communities, and they are specific to my business as far as like how they're able to help me. And I think that was like my strategy going into fundraising. And I also I found one of my investors during a pitch competition. They heard me pitch. I was 3rd place. And they were like, I love what you do. Let's talk. I could maybe want to invest in you. So I think it's just like kind of putting you out there, going back to what Will said, is like really doing the work to find the events that are tied to like your industry, or at least, or kind of pairing yourself up and making these relationships. Because I think relationships is a real thing that goes both ways. It's not just trying to get something out of someone, but it's really building the foundation for these people to also not just invest their time. Because I think the networking events can go beyond fundraising. It can go be like, hey, I know someone who can offer you a CPA discount, or I know someone who can, like, you know, who's looking to be a CTO and might in that industry. So I think there's a lot of benefit to consider, you know, when you're networking. It could just like, yeah, I'm looking for investment, but you know, what can come out of it, I guess, would be something that I would like to add to that. Amazing. I have definitely more questions. All right, so let's see. Great. For early stage founders, how many months of runway would you recommend raising for? And how can they justify this to investors looking towards the next round? So let's talk about runway. I think this is like, you know, let's start with what is runway? Anyone want to go first?
I guess I'll go. So runway is the amount of money that you need in order to survive as a business, pretty much. And my answer would be, in this economy right now that you still don't know what's happening, right? A lot of like things would be 18 to 24 months would be ideal, but obviously that's a lot of money sometimes. But that's the ideal one. Anybody else?
Yeah, I'd also say 18 months right now, like in this environment. I think that other investors also know that it's difficult to raise right now. And so is, you know, a longer timeline than that, is it giving you the time as a founder to make like meaningful progress and like make sure that you're hitting those metrics? Again, kind of going back to like the assumption versus realistic timelines of what you're trying to do.
I'll give I'll agree with the 18 to 24 months, but I'll give a little bit of a different take, because I know what we see dealing with a lot of pre-seed or, you know, pre-seed founders is, you know, that's great if you can mark out, all right, I need $1 million, it'll get me 18 months. Let me go try and raise $1 million. But actually getting that $1 million, you know, in one round is really, really hard. And, you know, we've got founders that have raised, you know, $500,000 to $1 million from 100 or 200 individual investors putting in $1,000 or $5,000 or $10,000, like really, really grinding. And sometimes it's just, how can I get more money in the door to just survive? So it is a nice and neat question to ask, you know, how much runway do I need? And if you're kind of going the VC pathway, that is absolutely a question that you need to answer, so you know how much money to go out and ask for. If you're not going that VC pathway, or you don't know yet kind of what you're going to do, then, you know, how much can you get, and without giving up too much of your company? There's no right answer, except for making sure that you can survive and keep building your company.
And I would say, as a founder, understand how much money you need to get to break even. It's really important for you to, as a founder, to understand that. You also have to understand, which is why it comes back to build your list of top 10 investors. You really have to kind of understand the investors' constraints and limitations and targets and what they're looking for. So my fund is on the smaller side. So I am looking, my sweet spot is companies raising under 1.5 million. So I do like those smaller rounds, right? Where a founder can raise some capital and then put it to work and show what they can do. Can they, if they're enterprise, can they launch their MVP and get into a few pilots? That is significant traction to get you to raise more capital from another investor in my network.
Amazing, guys. Thanks so much for answering those questions. I have an interesting question from the community, and I'm not sure if all accelerators do this, but why do some accelerate ask for equity in exchange for the funding that they do provide? And yeah, so why do they ask for common stock essentially?
So I guess I'll take that one. So the Long Beach Accelerator, we don't ask for common stock, and then I guess some, and it's interesting actually that some do ask for common stock because it's not something we do. So if anybody else has information on that, I'd love to hear that as well. But yeah, so we actually, through Sunstone Management, we have just a standard rate that we do for each of our companies. And so we offer $150,000 for 7% equity in our companies that we work with. And so that is just kind of the standard that we have set. In previous cohorts, it was a little bit different, but that's just the standard that the accelerator has right now, if that's helpful.
So I can, I wish it were easier for founders. Accelerators also come in different flavors, and some are dilutive, some are not dilutive, some take common stock, some don't. At Mila Capital, we would invest $75K in exchange for 7.5 common stock. And again, going back to know what a cap table is and what the difference is between common and preferred. That's really important. And we take common stock because we didn't want to imply a valuation on the company, because 7.5 in exchange for 75K implies a $1 million valuation, right? And we didn't want that to confuse other investors coming in. So we take common stock and sit right alongside the entrepreneurs.
Yep, same with Techstars, 7%, right? For that common stock as well. So we dilute with you, right? So we don't get paid until you get paid, if you get acquired or all that. So definitely, I would also read, right? Like Carmen said, there's all flavors and all types of clauses that go in there. So I would just research definitely what those clauses are, not just sign, because right now might seem easy and the money might look right, like flavor or juicy, but then at the end of the day, if you are planning for that long run, some of these clauses might impact you way more than you think right now at this stage.
Amazing. All right. Well, I think that this has been super amazing and informative. We're going to go into breakouts. Before